Hi all, let's start with the part 3 of collateral management session, and in this session we will talk about the future regulations that are coming in collateral management domain, the changes that are coming in collateral management domain, and how industry is adopting to the new ways to do collateral management. The very first thing that we are going to discuss is a regulatory change which is in form of central counterparty clearing. And in order to understand what that is, let's first have a view of how the OTC trades were cleared among themselves. So let's say there are three banks, Bank A, Bank B, Bank C, with each of the banks having their own customers. And if there was a trade that was to be cleared between Bank A and Bank B, there was a bilateral relationship between Bank A and Bank B. Similarly, Bank A and Bank C had a bilateral relationship, and Bank B and Bank C also had a bilateral relationship. It was good, but there was an overhead in this process, and there was also a risk, a domino risk in this process. So, let's say that there is a customer who has taken a loan from Bank A. Bank B would never come to know about it. And similarly, if there is a customer who has exposure from Bank C, then Bank A and Bank B will never come to know about it. So there may be a situation where there is a domino effect of a risk that in case if the customer is going bankrupt, then there would be a lot of domino effect in terms of Bank A, Bank B and Bank C getting hit. Similarly, there was another risk. What if Bank A goes bankrupt? If Bank A goes bankrupt, it will not be able to acknowledge any of the obligations that it already had for its own customers. Also, whatever is outstanding for Bank B and Bank C would also not be fully acknowledged, and there may be a great threat to the customers of Bank B and Bank C as a domino effect. Now, what CCP does is CCP says that everything should be cleared centrally. So instead of having bilateral links, there will be a central counterparty. All banks would be the brokers to that, and they will be selling and buying from CCP. So Bank A sells as well as buys from CCP. Similarly, Bank B sells and buys from CCP, and Bank C sells and buys from CCP. Hence, in case if A goes bankrupt, CCP is capitalized enough to take that shock, and it does, and there's not a domino effect because Bank B and Bank C are not going bankrupt because Bank A is going bankrupt. Bank B and Bank C are dealing with CCPs, and CCP is not going bankrupt. Hence, CCP will be able to keep its obligation for Bank B and Bank C. CCP may have a hit, but that hit would be netted, and hence the implication of that would be less, and CCP would be capitalized enough to take that sort of a hit. And the way it will be capitalized is there will be a deposit that would be done by Bank A, Bank B, Bank C to become member to the CCP, and it will have funds in order to take care of the risk. And the risk exposure would not be kept out for long, it would be only for a 1 day exposure that is there, and things would be settled quickly, and hence in case Bank A goes for a default, then the overall impact to Bank B and Bank C would be heavily reduced. Okay, so this is what the CCP regulation is. It is summarized in the next slide, which says that previously bilateral clearing was happening between counterparty A and counterparty B. Now CCP comes in between, so all the transactions get routed through CCP. CCP, you buy from CCP and you sell to CCP. Similarly, counterparty B buys from CCP and counterparty B sells to CCP. In case counterparty A goes for a default, it's the responsibility of CCP to pay counterparty B. The mesh that was there previously is shown in figure 2, which shows bilateral clearing, and after central counterparty clearing, the architecture would look more like a star. Some of the differences that are mentioned. So in bilateral, there was a web of counterparty exposures. No one really knew what is the total exposure they were having, and there was a domino effect with respect to exposures. But it's a hub and spoke model, so I exactly know that how much exposure I'm having from A, and the market also knows that what is the total exposure from A. Complex collateral movements were there previously because of bilateral relationship. Now all collaterals are also moving from CCP, and hence the overall credit risk is getting reduced. The potential domino effect, which may be arising because no one knows what is the total exposure of A, because A and F are having bilateral relationship, A and B are having bilateral relationship, A and C are having bilateral relationship. No one knows overall what is the total exposure, but in case of a central counterparty clearing, since everything is getting cleared through central counterparty, we know that what is the overall exposure of A, and in case A goes for a default, what would be the total hit. The second thing that is happening in the industry is that collateral management is now looked at an enterprise level. Previously, it was being looked at an asset class level. So, asset classes could be lending, asset classes could be FX transactions, asset classes could be equities, and each of those asset classes were maintaining their own collateral. So, at one particular point in time, a big bank may have a big bank may be dealing in 12 to 15 asset classes, and if each of the asset classes were maintaining their own collateral, there may be certain areas of the bank where the collateral may be unutilized, certain areas where collateral may be overutilized, and certain areas where it may be 50-50. And then every asset class was doing its own trading, netting, settlement, and custody. So they were talking to all these four departments separately, and there was a complex web of transactions flowing through from all these asset classes that may be there in the bank. Now, what's happening is that collateral management is now done at an enterprise level. So all the asset classes would be posting their collateral at an enterprise level to a central area where the total collateral management function would be done, and then collateral management function would be talking to trading, netting, settlement, and custody functions that are there. And hence the small red boxes that are there in trading, netting, settlement, custody, those are also getting reduced because a lot of netting may be happening within the collateral management department itself, and the utilization of collateral may be better achieved across the enterprise rather than doing it at the asset class level. The third thing is that a lot of focus is going on with respect to handling the collateral. Collateral is an inventory. Like any inventory has to be looked carefully with respect to the optimization, what comes in, what goes out. Similarly, collateral being an inventory needs to be looked at very carefully by the bank. And the parameters on which this inventory is optimized is you have to see what is the funding cost for the collateral, how much it takes you to get that collateral or give that collateral, what is the eligibility criteria of the collateral, so which type of counterparty can take, or which type of counterparty can take a particular type of collateral as an eligible collateral for them. What is the concentration of overall collateral in the enterprise? It should not be happening that we are generating a concentration risk because we are taking only one type of collateral or collaterals from one industry only. What are the haircuts with that collateral, which particularly is around the riskiness of the collateral or riskiness in the future value of the collateral. Then there is a settlement cost, how much time and effort and money it takes to settle the collateral. Then there is a substitution effect, which can arise due to two factors. First, because there may be a concentration risk which you want to mitigate by doing substitution. And second, there may be corporate actions that may be initiated. So corporate actions, as I told you before, is a phenomenon when, say, some equity is paying a dividend, we give back that equity to the person who has borrowed funds from us and ask another collateral, substitute it with another collateral, and once the corporate action of paying dividend is complete, we take back the collateral. This way, there are tax implications that we don't have to take care of, and there are the service charges we don't have to take care of. Then there is a relationship cost. So there may be customers who may be dealing with us on a regular basis with us. So what type of collateral we are giving them, or what type of collateral we are taking from them vis-a-vis their customers who are one-timers, and we don't have a much relationship cost with them, and hence we can ask them literally whatever is the collateral we deem fit for that type of transaction. So collateral optimization has to be done based on that, and there are practically three strategies that are there. The very first one is cheapest to deliver. So it means that as soon as you figure out that you have to give collateral, you go ahead and give the collateral that is the cheapest in order to deliver, uh, in order to exchange. So if he's accepting BBB bonds, we can directly go ahead and give them BBB bonds rather than trying to give them uh, AAA bonds or AA minus bonds. Similarly, the second strategy is hardest to place. Hardest to place strategy exists because if you have formed an enterprise collateral function within the bank, you will come to know there are some collaterals that are not fast moving, and as soon as there is a demand for that type of collateral, you can clear it off or you can place it off. They were hardest to place because no one was trying to take it, but if you find an agreement where you can place this collateral, it would be easier for you to do that, and it would be beneficial for the bank to do that. And then there's the final one, which is the most important one and the hardest one to achieve. That's the hardest to please. In this, you construct an overall portfolio of collateral that you have, and then you run algorithms not based on counterparties but over the complete portfolio to say that if they are AA collateral, we will give it to these type of counterparties. If they are BBB type of collateral, we'll try to give it to Y types of counterparty. It's just like the difference between cheapest to deliver and hardest to please is, let's say that there is a stadium and people are coming into the stadium. When the person comes into the stadium, you decide what is the best place for him to, what is the best place where he can sit based on his based on the nature of whether he's a VIP person or whether he's a common person or whether he's XYZ person. So you will give him the best seat, but whatever out of whatever is available. Hence, the if a VIP person comes in very late, he may not get a best seat and he'll have to compromise it at a worst seat because there was no best seat available. If the stadium is really full, and let's say at the last of it, Sachin Tendulkar walks in, since there is no seat left, whatever best seat we can find for him, we'll give him and we'll ask him to sit. It may be very difficult for him to watch the match in that situation. So similarly, the second concept, hardest to please, is that you divide your stadium in at least three parts: category A seats, category B seats, and category C seats. So category A seats are reserved for VIPs, category B seats are reserved for people who have paid higher but they are not, there are let's say category A is for platinum clients, and category B is for gold clients, and category C is for silver clients. So now when you have to give the collateral in order for a platinum client, you will have different considerations vis-a-vis if you give it for gold client and vis-a-vis if you give it for silver clients. So that's the hardest to please, where the entire portfolio is constructed, it's divided, and then based on the priority of the counterparty, an algorithm is decided. This is also shown in the same diagram how enterprises are looking at it. So first they are starting with finding how much it takes to clear the collateral. So what is the cost of keeping that collateral and settling that collateral? Based on that, they want to do an optimization. The collaterals that are hard to clear, they move it out first, vis-a-vis collateral that are good to clear and are very less costly to clear. So if there is a counterparty to whom you have to give Indian bonds, and that counterparty belongs to US, you would not go ahead and give that, because it will take a lot of time for you to get that collateral cleared. But if you can give them a BBB, maybe a US bond for them, and if you find a counterparty in India who has to be given a collateral, then you can give that Indian bond collateral to him. So based on the location, which is the collateral that is good to clear is decided over here. And then implement cheapest to deliver. So based on his agreement, what would be acceptable to him, you figure that out, and then you use that as a parameter in order to give the collateral. Set up enterprise collateral function. So once you set up an enterprise collateral function, you'll figure out which is the hardest to place, which collateral is not so fast moving and you're not getting it cleared and you want to move it out of its book. So as soon as there is an agreement which can take that type of collateral, you will use hardest to place algorithm to clear that. Then you can implement hardest to please algorithm also by creating a overall view of the collateral portfolio that the bank is maintaining, and decide for which bucket of counterparties you would give which type of collaterals. You'll also do relocation and substitution based on the concentration risk and the cash actions that you may have in your portfolio. Then there is a best execution decision optimization, whether you want to do it bilaterally, whether you want to do it triparty, or whether you want to do it CCP. Very quickly, everyone would be moving to CCP, so there should not be any bilateral agreements and collateral settlement via that method. Then there are forecasting based techniques. It's very common in inventory management to do forecasting based, but in collateral we were not doing that. But we can always look at the trends at which the customer is doing the transactions and can predict the future exposure and can start anticipating the collateral requirements. Then there's what if scenarios. What if scenarios are particularly type of stress testing scenarios where you figure out and say, let's say 10% of my BBB minus collateral becomes illiquid, and what would be the implication of that on other collateral and my collateral management function. So these are all what if scenarios that you can create. And finally, a cross product netting type of activity that you do is that between investment bank, between retail banks, between corporate banks, if there's a cross product netting that can be done for collateral, that can also be looked at. So there are three things that are happening, particularly the CCP side functionality that's getting implemented. The second is setting up of an enterprise collateral desk. Banks are working on that. And third is doing inventory management and optimization of that inventory. It's not at all a new concept. It used to happen in some of the other industry, particularly in terms of retail and in terms of consumer product. A lot of inventory management algorithms and optimizations techniques already exist. We are just trying to build those techniques into the bank in order to manage the collateral effectively and ensure that the overall cost of handling the collateral and overall credit risk exposure is reduced. With Basel III coming into picture, where there would be a lot of scrutiny with respect to the capital that we have and the risk-weighted assets that we have, doing a collateral management to reduce the credit risk would be a significant function. Now coming to the last slide, And in this slide, it would be the collateral services architecture that is evolving, and that architecture is particularly with respect to taking the transactions from a transaction data store. It will come with positions and valuations. There will be a service, and that service can also exist in cloud to do the allocations. In order to do the allocations, there would be services in the cloud which will give you the reference data, which would give you the risk data. These two, reference data and risk data, can be activities that can be outsourced, and you can get that data from some of the vendors that already exist on the cloud. Then there would be agreement data which would be generated, or which would be kept on your golden source based on your agreement with the counterparties and your customers. Taking that allocations and taking that static data in form of agreement data, reference data, and risk data, you will be able to generate margin calculations on a client basis rather than what currently banks are doing. They are doing it at a batch basis. They can move away from that batch processing of margin calls to the client basis. That will improve the performance to a great extent, because in batch basis what is happening, that there are delays that keep on happening with respect to the batches, and hence the margin calls are getting shifted. Now you don't have to wait. As soon as the transactions become available for a counterparty, you can run that margin calculations, you can do portfolio reconciliations, you can go for confirmation with the clients, then call the margin call and have a margin call in case there is a margin requirements, do the settlement, and do the dispute management as and when the trades are becoming available for the counterparty. The second leg of it would be maintaining an collateral management reporting OLAP database. And what that OLAP database would be doing is that it would be doing an inventory management exercise with respect to selection, substitution, optimization of collateral, producing a list of collaterals that are available for rehypothecation so that you can reduce the cost of borrowing. It will be tracking for acknowledgement of settlements, and it would be doing a lot of netting functionality. These are typical part of inventory management exercise which are done in any of the functions that are there in terms of consumer durables and other product industries that are available in the market. Finally, there would be feeds and reporting that would be generated. Feeds and reporting, these would be generated for regulatory, risk, finance, ops, and analytics purpose. So this feed and reporting can be overnight, or some of it can be online as well. But the main thing to focus here is that all things are services, and these services are created to move away from the batch based working, where the collateral, the margin call function was done at a certain times of the day only. With the service model, you can do it as soon as the transactions become available, and you can raise a margin call with the customer. Maybe your thresholds will be kept high, so that as soon as you cross a particular threshold, only then you raise a margin call, but the calculation nevertheless can produce on a real time basis. Thank you. Thanks a lot. I will come back with some of the recent changes with respect to initial margin and with the amount, part of regulations that are coming in collateral management area. Till that time, bye. See ya.